Good morning. Welcome to Capstone Coffee Conversation. My name is Ryan Skogstad, and this is Robert Huff. We'd like to talk today a little bit about how to align your financial advisor with your CPA or tax accountant. As many of you know, over the last few months, Capstone Wealth Advisors has affiliated with West Sound CPA, and we've been looking to do that for some time. We've always worked closely with tax preparers and CPAs, but what we feel this marriage or union brings for clients is a way to seamlessly combine tax planning along with financial planning. And a lot of times, you go to one place and you get a portion of your financial piece done, and then you kind of have to take that, and a lot of times notes and what have you is lost in translation. And so we feel it's a really good partnership to align your financial planning and tax planning and getting that done in one location where they're working in concert together for the benefit of the client. So that's something we're trying to introduce to current clients of Capstone and prospective clients. West Sound CPA has been operating that way for quite a few years. And so we're looking forward to this relationship and beginning to assist clients in a deeper level and probably creating a better experience for clients in the long run. So what I thought we'd do today is I'm just going to ask Robert some questions and kind of give him a chance to talk about some of the things that he sees as he sees tax returns come across the desk for businesses and individuals, and what are some highlights that he can bring to begin to assist people that maybe people aren't doing currently. So Robert, let's first off talk about the business owner. You guys do a lot of tax returns and a lot of planning for business owners. Tell me just in general, 30,000 foot view, what does a relationship and planning look like when you're working with a business owner?
So when we meet a new business owner, the first thing we like to do is to make sure they have a solid accounting system. We usually recommend QuickBooks. Once we have their accounting system understood, we like to provide as much or as little help as they like. We can be very hands-on, or we can be hands-off. So it's really up to the client how much interaction they want with us. At a minimum, we like to review their accounting once a quarter. That way we have a good idea of what their financial situation looks like throughout the year. When we get into the third quarter, we like to start our tax planning for the clients. That's where we take 9 months of actual data, estimate the fourth quarter so that we have a full year to work with. We estimate their income tax liability so that there's no surprises when they file their tax return in April. And if they have a tax bill due, that they can plan for it.
Okay. Yeah. And then so we do, and we've done the same thing with clients as far as investment planning. That meeting on a quarterly basis kind of keeps you abreast of what's happening, so you don't get a year down the road and then try and fix things from a year ago. With that quarterly planning, if you're touching base, you're probably in front of the issues and able to help the client in better fashion than looking backwards.
Yeah, it allows us to be proactive instead of trying to make corrections after the fact.
Yeah, absolutely. Good. So maybe highlight a few strategies that you see that maybe some business owners might be missing, that when you do look at past returns, things that you're able to help them with from the past or going forward.
Yeah, so one of the biggest ones are depreciation deductions. More times than not, business owners don't deduct as much depreciation as they're allowed. And that usually is a result of not allocating out some of the bigger purchases into shorter asset life years.
Okay.
So we analyze their depreciation schedule, and if need be, we'll make corrections in the current year, which allows them to retroactively take deductions,
okay,
all in the current year without having to amend prior tax returns.
So if they've made a mistake in the past, you can just fast forward that. And
that's right.
Yeah. Okay. And you were mentioning to me, like if somebody's buying or refurbishing a commercial property, that depreciation schedule can be 39 years.
Yeah. So more times than not, that's a 39-year write-off. But again, what we do is we prepare a cost segregation analysis where we look at each line item of the contractor's build estimate and break that out into the correct asset life.
Okay.
So instead of depreciating things over 39 years, we're able to probably accelerate at least half of the cost into to 5, 7, and 10-year life assets.
So you'd have, maybe it's one big spend, but each piece of assets has different depreciation schedules, allowing them to fast forward some of that deduction.
That's right. Yeah.
Okay.
Exactly.
Talk to me a little bit. What other things do you see that people are missing or businesses are missing?
So a lot of times, auto deduction. There are a lot of trips that you make that you can deduct as business if your intention is documented. So with the IRS, it really comes down to documentation. So if you're going to the store, for instance, and you buy your personal groceries, if your intention is to go buy something for your business and you document that, that is now a business deduction. It's business mileage.
Okay, great. I know I've downloaded an app on my phone that helps me keep track of that, so I'm not always having to get a logbook out, but that's something that you help me with, that then we can get the most potential deduction out there. You were talking earlier too about creative hiring, and if you have small business owners and if you have a family, talk to me a little bit about what you mean by that.
Right. So whether you're a sole proprietor, a partnership, or a corporation, you can hire your kids as employees of your business. You can pay them up to $12,200 a year,
okay,
which is a standard deduction. They'll pay no income tax on that income. Now that they have earned income, they can turn around and make a Roth IRA contribution.
Okay.
So it's a great way to fund a Roth IRA for your kids.
Yeah.
And get a business deduction in the process.
So money goes in for a Roth. The kids don't have to pay any income. Takes the money off of your income sheet, right? So you're just basically reducing your income. You're reducing your tax, putting it on child who doesn't pay tax, and then funding a retirement account or a Roth IRA or something like that.
Exactly.
Roth IRA, education. You can pay for education out of a Roth IRA, first time home, or obviously retirement. Okay. Last one, you mentioned renting out your home or a personal residence.
Yeah, so the IRS allows every taxpayer to rent their personal residence up to 14 days a year and not report any of the income on your income tax return. So again, we like to recommend that our business taxpayers, that they rent their personal residence to their business. So this is for a partnership or a corporation. So you can rent your personal residence at fair market value up to 14 days a year, take a depreciation or take a deduction, a rent deduction for it, and not report it on the personal side of your income tax. So you get a deduction in the business and don't have to report the income personally.
Okay. So these are all types of things that you look at in the quarterly review planning, end of year planning, that you're trying to maximize these deductions for people and reduce their tax burden.
It is, yeah. And once we have established a relationship, that's something we would like them to implement throughout the year.
Yeah.
So they have 14 days throughout the year to have offsite meetings at their home. They document the business purpose of the meeting, actually pay the rent, write a check, and deduct it.
Great. I know this year's been unlike any other, and we've seen the invention of the PPP program, the Payment Protection Plan, I believe, is what it's called. So the PPP plan gets a lot of notoriety. Is that something that you help clients navigate in applying for forgiveness or what have you?
Yeah, so I would say most of our business clients applied and received PPP loans.
Okay.
And we were involved from beginning now to the end, which is the applying for forgiveness. So the whole purpose of the PPP loan was to keep people off unemployment, right? To keep people on the payroll. So what we did is we helped people apply for the loan itself, apply for forgiveness at the end, and in between the loan funding and the forgiveness, you have to make sure that you spend 100% of the loan proceeds on qualified expenses. If you don't, you have to pay that back. So that's a really big piece that some people are missing. And that's where we step in and make sure that they that they're paying out 100% of the loan for qualified expenses, and that their FTE count doesn't drop from last year. That's the other side of it.
Okay, full-time employees have to maintain that level
Yes.
to get forgiveness from the PPP. Okay, let's switch gears. And on the personal side, there might be a couple things that people are able to do. Maybe let's say that somebody, individuals have like a rental, something in that regard. On the individual side, are the things that you try and coach people or that you see that people are missing? If it's a pretty simple tax return, but maybe they have a rental property or something like that.
Yeah, so for a rental property, again, we like to make sure that they're deducting everything possible. So mileage, whether you're going to the post office, the bank, if it's related in any way to your rental property, you should document the mileage and deduct it. Anything you pay out of pocket for the rental property should be deducted. And again, going back to the depreciation, rental properties are depreciated over 27.5 years. So we like to, again, look at what's inside the house and make sure that's recorded on the depreciation schedule and depreciated over 5 and 7 year asset lives.
Okay. Finally, talk to me about somebody that doesn't even have a rental, but they're pretty simplistic. Just want their taxes done. Is there anything that you look for that you might be able to help strategize them where they can keep more money or grow it tax-free, things like that?
Yeah, there are situations where we might want to help somebody maximize their tax bracket. And what I mean by that is if they're taking distributions from their retirement plan, we like to make sure that they don't step over the next tax bracket.
Okay.
So we do a tax estimate and find out how much they can distribute in the current year. And if they need more than that, well, they can turn around first week of the next year and take the rest.
Okay. Yeah.
We also look at Roth IRAs.
Okay.
If someone makes too much money to contribute directly to a Roth IRA, we can do what's called a backdoor Roth. That's where they contribute to a traditional IRA. They don't get a deduction for it, so they can turn around after they make the contribution to the traditional and convert it to a Roth IRA, where it goes tax-free.
Yep.
And when they take the money out of the Roth, it's tax-free at that point as well.
So people who run out of, make too much, the government doesn't allow them to contribute to a Roth. This is a way to contribute to the Roth and backdoor Roth, basically. Yes. They can grow that tax-free. That's a great benefit. You mentioned you like to see the last 3 years tax returns of either a business owner or a personal tax return. What does that help you do for them if you're looking at the last few years?
Well, so we like to look at the last 3 years because that's how far back we can amend returns. So we look for missed deductions, credits. We've seen in the past where people have taken early distributions from their retirement plan, but they may have qualified for an exception to the penalty and didn't know it. So we, quiz them and find out if they did spend the money on one of the items that there was an exception for.
So you can go back 3 years, make amendments, and if it makes sense, maybe they have some money coming back to them that they already paid tax on previously.
Yeah, and again, on depreciation, if they have a rental property or a small business, sole proprietor, many times we've amended past year's returns and then gotten back thousands of dollars.
Yeah. The last thing that I would add to that is as advisors, we're always looking at tax loss selling on the gain side or matching that up with losses. And again, this year's seen a little bit of everything. We've seen large losses in some areas and large gains in another. And it's really helpful to work closely with your accountant CPA to say, should we be taking gains this year? Should we be taking losses? Do we want one more than the other? And try and match that with what else is happening in the world for their business or their rental or their income. And maybe it's a year where you take gains. Maybe your business is way down, or maybe your business has done very well and we want to take losses. And it's nice to have that under one roof, working in concert together. Obviously, we're not going to answer everybody's tax questions today, and we're not going to get anybody's tax return done over this meeting. But I think those are some great strategies and just high level items that you bring up that a lot of people are missing. And that's, I guess, one plug to have you review, look at past years, That's not necessarily a cost item to go review the past years, but it helps us to begin a new relationship and then maybe kind of unionize your advisor and your CPA.
Yeah, it's free of charge. We don't charge to take a look at the past 3 tax returns, so no charge for that.
Awesome. Thank you. At this time, we'd like to see if people have questions. If there's anybody that has, feel free to key those in. You can send a chat to Kennedy. If you just type in a question in the chat box, then Kennedy can read those out.
So it looks like we have a question here, and the question is there a tax advantage of recording mileage versus just writing off fuel expenses?
So in that situation, the IRS allows you to either take actual auto expense or the standard mileage rate. The actual auto expense is the cost of the vehicle, fuel, any maintenance, tires, repairs, insurance. So you need to look at both sides, okay? If you drive a lot of miles every year, the standard mileage rate might come out as a bigger deduction. If you have a very expensive vehicle, the actual auto expense might come out as a larger deduction. So you have to look at both sides and take the higher of the two.
Is that something you help people navigate?
Yeah, every year.
Okay, good question.
It looks like we have another question as well. I am currently a sole proprietor, and I have heard that I can save taxes by incorporating. When should I do that?
So I think what they're referring to there is payroll tax savings. So as a sole proprietor, you pay 15.3% self-employment tax on your self-employment earnings. Okay, that's on top of your ordinary income tax. So a lot of times, if their income is at the right level, we might recommend that they incorporate. And what I mean by that is S corporation. And usually we're referring to somewhere in the neighborhood of $75,000 of earnings. So instead of reporting that as a sole proprietor and paying 15.3% self-employment tax on that, they can incorporate, take a reasonable salary, say maybe $50,000, and what they do is they save 15.3% tax on the difference, which is $25,000 in that case. So it's a case-by-case situation. We have to look at all the facts and circumstances, but there is a good time for sole proprietors to incorporate.
Perfect. And then it looks like there is one more question. If I don't live in that area, how do we get documents back and forth securely and begin working with you?
So we have a secure portal. We do share file, and with that we can transfer files back and forth through the cloud. It's completely secure. We work a lot over the telephone with clients. As a matter of fact, I mean, a lot of our clients are out of the area.
Yeah.
So that's not a hindrance whatsoever.
I think everybody's a lot more comfortable with Zoom, obviously, these days. So we do a lot of Zoom meetings, but the ability to transfer documents on the advisory side or the CPA side very simplistically through ShareFile, which is a link that we can send out to people and they can just upload on their computer, enables us to get that information back and forth. Good. Well, Robert, thank you. Appreciate you kind of highlighting some of those strategies. We look forward to any further questions. Obviously we're not solving all the problems today. Please join us for our next Capstone Coffee conversation, or the second Tuesday of every month at 9 a.m. And the topic for next month will be disseminated over the course of the next few weeks. Lastly, follow us at Capstone Wealth Advisors on Facebook or Instagram, Capstone Wealth Advisors, or visit our website, capstonewealthadvisors.com. Thank you.